We're going to go to the people in the know. The panel today, James Freeman from the Wall Street Journal, Deirdre Bolton from Fox Business, and Heather Zumarraga, Vice President of Vision 4 Fund Distributors. Heather, let me start with you. What do you explain for the Dow being up triple digits? Is it a take by investors that perhaps this jobs report indicates to them that the Federal Reserve will or won't raise interest rates, or is it something else?
Absolutely. It's a jobs report right now having ticked higher at 4% from 3.8% unemployment. Sounds bad on the surface, but when you dig a little deeper, I'm really excited. More people are coming back to work, increasing the labor market force. That means they're more confident about the economy. They're saying, hey, I want to go get a job, so it's okay if the unemployment rate goes up. That means there are more people out there looking for work. And second quarter earnings, we're about to embark on second quarter earnings estimates for the markets are expected to grow over 4% across the board. So earnings are doing very well. I expect many companies to attribute some of their increased profits, again, due to the tax cuts that's still going to take effect.
So, James, nobody's going to think that it's a bad thing that more people are coming back into the workforce. The Fed hinted yesterday, we saw in the minutes, that they say there's slack. There's plenty of room for more people on the sidelines to come back in. But labor force participation is still at a three-decade low, basically.
Yeah, so I think you have room to grow. And this is, I think, a good day for people looking for work. A bad day maybe for people who've been saying that we've hit a limit, that we're at full employment, we're at the end of an expansion cycle, things really can't get better. Maybe they were saying we're in the new normal a few years ago. So these are all good signs we're seeing now in the economy, that those limits aren't there, that more people can join the workforce, the economy can grow faster. You've still got almost 8% of the population in what they call the U6 category, a little broader measurement of unemployment. And it's been flat.
U6 has been kind of flat, though, for several reads.
That's right. But it is a sign that there are more people, if given the incentive and given the encouragement, who will come back into the market. Also, the quit rate. People are confident quitting jobs now because they think they can get another one.
Yeah, in fact, Deirdre, hold on one second, Heather, because I want to get Deirdre into this. I read that one of the quit rate factors is that people who are doing this are, on average, getting about a 30% increase in pay. But for people staying in their jobs, wages growth year over year
very stubborn, right?
2.7%. It's not really growing at the rates we would expect.
Right, and not that we want to completely nitpick what economists forecast, but most were looking for 2.8%. So to your point, that wage growth is very stubborn unless people are actually jumping. And I know, James, your colleagues wrote that fantastic piece in the Wall Street Journal yesterday,
Thanks for that.
Which was called "The Quitters Are Getting Ahead." And it was all about what you're talking about, Adam. If you want to get a better raise or a different salary, you got to move shops. I think overall, though, 93rd consecutive month of jobs being added to the U.S. economy. This is the longest streak on record. And if you look at Fed funds rate, it seems like the Fed took this morning's data as a neutral, meaning, OK, we're still going to raise rates 2 more times this year, which kind of follows what I think most market watchers expected. So that's a steady. To me, actually, the wild card is the trifecta, the combination of the Fed's raising rates, even if it's well telegraphed, along with higher energy prices, and then the unknown, the X factor of what the tariffs may or may not do, right? This tariff tiff, if not war, that we're having right now. So that's the formula that I'm following in those 3 moving parts.
Well, Heather, pick up on what Deirdre was just saying, because I would take a read, and I'm not a Fed expert, but the fact that inflation is rising, but we're not, they said in the minutes, we can't declare victory, that we're at the 2% target yet, and the fact that wage growth year over year is not what the Fed really thinks it should be, wouldn't that signal that although the dot plot says 4 increases this year, maybe it's just 3?
You're right, and that's why some investors are calling it the Goldilocks scenario. The fact that we can have this type of growth in the economy, over 2% or over 3% perhaps this year, and yet inflation still remains low with unemployment at very low levels. So the fact that there isn't wage growth, the average American walking on Main Street, that's not good news for them at only 2.7% year over year. But that's good news for the markets and the economy in the end. If the Fed isn't going to raise rates sooner than maybe the markets can handle. Although I would argue they should have raised rates a long time ago.
But James, you look like you wanted to jump in on that. And I keep focusing on wages because at the end of the day, if people are making more money, or at least think they're making more money, that's how they vote. And that's the biggest thing that drives voting. We're coming into the midterms. So are we in a good trajectory if you're a Republican, or are you a good trajectory if you're a Democrat?
Yeah, I think Democrats have to be nervous with how strong this economy is looking, that the job creation, we've had good manufacturing data, services data, all parts of the economy. And now, although President Trump overall still low approval ratings generally, historically, he's now at a majority of the people in the country, according to the average of most polls, who think he's handling the economy well. And it shows in the data. You understand why they're more optimistic, why they starting to think the U.S., its best days are still ahead, starting to think that way again.
And at that point, Deirdre, you brought up the tariff tiff. Let's just call it the tiff. And it's targeting Donald Trump's base in the farm country.
None of these countries that are acting sort of in response to what we have done are stupid, right? It's nobody's first rodeo. So you have China, to your point, hitting back at soybeans. That is, depending on how you measure it, let's just say roughly a $14 billion export crop for us. And that hurts 7 of the 9 states that voted for President Trump. So this is not China's first go-around. It's not their first strategy session. Mexico imposed, as of yesterday, about $3 billion worth of tariffs against American goods. Now, that is obviously still less than the EU's $16 billion and Canada's $16 billion. But, you know, you just have to begin to add all these up.
There's a trickle down. India has slapped tariffs against U.S. goods.
Yes. So I think for the moment, what the stock market is showing us is that investors are ready to absorb these levels. The ones I'm personally afraid of are the headlines that may just be a negotiating tactic, but the 200 billion levels, I think those are game-changing. 36 billion, obviously.
Heather, you get the last word. Will we go there with the 200 billion more in new tariffs?
I just think eventually, and this is China's point too, is you're going to run out of tariffs. You're going to have to look for other sources to attack each other on non-tariff barriers like open markets and other things like stealing intellectual property, because you're going to run out of tariffs of stuff to tax eventually. So, yes.
James, Deirdre, and Heather, you know, talking about all of this, Donald Trump is kind of like Joan Crawford at the Pepsi board meeting when they say, "Don't F with me, fellas." So we'll see where this all heads. But thank you for joining us.